if I was to just kind of move 2007 back, we're in a very similar situation. All of these assets have come to life. It's become the crowded play. We're having the first little pullback and pause. And then I think we're going to see gold in the precious metal space shoot higher fairly dramatically. I think gold's going to go to 51, 5,200. Silver is going to shoot higher, where I think gold and the precious metal space have one more big run. I do feel like Bitcoin's lost its shine. I think, Ethereum got some good traction, really took a lot of focus away from Bitcoin. Gold's back to life, and gold, silver, and miners. I think a lot of people who are in the crypto space were and are gold bugs. And of course, they want to move to what's working.
In a recent discussion, market analyst Chris Vermeulen shared his thoughts on the similarities between today's market setup and that of 2007. According to him, we're in a phase where nearly every asset has come alive, a crowded play that's seeing its first pullback before what could be another powerful rally. After this short pause, he expects gold and the broader precious metals space to surge higher, potentially in a dramatic fashion. Vermeulen believes gold could climb toward the $5,100 to $5,200 range, with silver following closely behind in what might be its most explosive move yet. He suggests that while cryptocurrencies like Bitcoin have lost much of their previous luster, the attention is shifting back to tangible, time-tested assets such as gold, silver, and mining stocks. Ethereum, he notes, had its moment of momentum, but the energy now appears to be flowing back into metals. For many investors, especially those who once viewed crypto as digital gold, this renewed interest represents a return to the fundamentals of hard assets. With gold and silver regaining strength, the stage may be set for one more significant run in the precious metals market. If you found this helpful, like, share, and subscribe to the Metal Bar. Turn on the bell so you don't miss any updates. And comment below to share your thoughts on gold, silver, and the markets.
The stock market was making an all-time high back in 2007. Gold, the yellow line, was pushing up to all-time highs. And then finally, we started to see the stock market struggle a little bit. Gold started to pull back. I kind of believe we're in a similar situation in terms of price action. We've got gold pulling back. There's a little bit of fear in the market, very similar to what we saw just over here in 2007. And what's interesting is if we look on the left chart, I've layered in multiple different assets down below. So we have GDX, which is gold miners. We got silver, platinum, and palladium. And this is what I've been talking about for the last little while is everyone's been piling into gold. It became a short-term crowded play, which is why we've got this initial little pullback. But you can see that in this chart. When we look at what people have been doing with gold miners, with silver, with platinum, and palladium, money's been moving into this space. So whoever's open to the concept of holding physical metals, they have been piling in. It's been a little bit of a feeding frenzy. Things got a little overbought. When we look at what happens after this, we tend to see the yellow line, gold, shoot dramatically higher, rallies about 30%. The stock market ends up struggling. So I think money pulls out of stocks. Money's always looking for a return. So it's going to move to whatever's got momentum, which is gold. It's also going to be miners. It's going to be silver, platinum, and palladium. Gold had hit our measured move right over here. We ended up playing this really nice trade to the upside on this breakout. And then after that, it went into this kind of bubble feeding frenzy mode. And everybody who got out with me on this target, because it was a pure technical trade, that was our target, get in, get out. Everyone had FOMO at this point. Everybody's like, why did we get out? I have to get back in. And tons of people got back into gold because they thought they were missing out and it was going to go to the moon. And now here they are underwater. And now I actually like gold here. And everybody's like, why do we want to get into gold? It's reversed. It's selling off. And so these are these important like turning points. When everybody wants it, you don't really want it. And when nobody wants it, especially when it's in a super bull market like gold right now, that's usually marking a low. So I think gold is trying to find a bottom here. I think we're going to see that happen fairly soon because everybody seems to be bailing on their gold miners. As you said, they're moving out, they're selling off, and they're kind of giving up on it. And I think we'll see a bottom potentially this week in the precious metals space. And miners are down the most because they're kind of this very liquid. They're not very liquid in terms of they sell off. They're a small market, and when people sell them, they drop quickly. The metals are holding up better. They're not making lower lows at this point. They're not breaking the lows from about a week ago, and that's I think because they're not connected to the stock market. The stock market is pulling back. Gold miners are stuck in the stock market, and as you and I have talked about, I look at the markets like the ocean tide. When the tide goes down, all boats go down. So if the stock market tide is going down right now, and you got a gold miner that's stuck in that tide, it's naturally going to have more pull to the downside. Whereas gold and silver are a commodity, they're not even connected to the stock market. And so they're holding up better because they don't have that falling tide with the mass psychology of everyone kind of dumping stocks and selling. So I think gold miners are telling us what the sentiment is. People are panicking, they're selling and moving out. And I think it's telling us, and gold and silver are holding up. So I think it's an emotional pivot low, and I think we're going to see the market carve a bottom out if it's not already in. For people are nervous, and when people get nervous, they tend to liquidate everything. And even if it's something that should be in favor, like precious metals or miners, they just tend to sell everything. And this is a good sign. This is generally telling us that this is a kind of a tipping point. Once the masses kind of release their shares into the wild, into just they exit, usually the market wants to turn around. And the amount of sectors on our hot list here, they're pretty much all negative. We have a large group of them in, with all kinds of short-term downtrends. I think we're going to start to see this market kind of carve out a bit of a bottom and try and figure out a rally. I think the stock market is in for a rough ride. I think gold and silver are primed for kind of to benefit the most over the next month or two. Seasonality wise, when we look at the markets, if we look for the stock market here, typically from the beginning of November to the middle of November, the stock market struggles a little bit. So that's right where we are. We actually saw the market push higher going into November, and now it's starting to pull back. If you look on the chart, we had a run up into November, and now it's starting to pull back. So seasonality seems to have its claws into the stock market. If we look at gold, it's kind of the same. Gold kind of holds its ground and struggles. And then, of course, it still has more pressure into the middle of November. So I still think we're going to see a little bit of profit taking, a little bit of panic selling for the next more so 10 days or so, 7 to 10 days. And then we're going to have a tailwind behind us for the precious metal space and the stock market as we go into that holiday end of year rally. There's increased volatility, higher risk of it failing. And of course, you have bigger potential losses. So again, like right now, it's had this huge sell-off, and this pattern is so unpredictable that it could very easily be back up at $128,000, dollars a Bitcoin a month from now. And I'm not saying that's going to happen, but that's what this pattern shows. It's very unpredictable. If we zoom back on the pattern, you can kind of see a similar type of move here where we have this kind of little bit of a broadening formation. It kind of gets pretty noisy. You could argue it's more so a double top. I feel like where we are right here, where we are right now is kind of over here. I think it's going to be a rough ride. It's going to try and stabilize. I think a lot of people that got into this whole phase right through here, I think they're going to get shaken out. The market is probably going to gun to break this 98,000 or 99,000 level and try and get all of these investors through this whole time to bail out. That's what the market loves to do. Just like over here, it breaks down, it stabilizes eventually, and then starts a new move up. So I think we're going to see Bitcoin continue to flounder and struggle going forward. I wouldn't bet on the downside. Again, this pattern shows that it could reverse and have a huge rally.
In his latest market analysis, Chris Vermeulen draws a striking parallel between today's setup and the 2007 market cycle. Back then, the stock market was at all-time highs, while gold was quietly preparing for a massive breakout. Now, a similar pattern seems to be unfolding. Gold has pulled back slightly, sparking fear among investors. But that kind of sentiment, Vermeulen suggests, often marks an important turning point. He explains that while everyone piled into gold during its recent rally, the short-term crowding led to a pullback. Yet, history shows that after such pauses, gold tends to rally sharply, sometimes as much as 30%. Meanwhile, stocks appear to be losing momentum, and as money seeks better returns, it often shifts into gold, silver, and miners. Currently, gold miners have been hit hardest because they're tied to the broader stock market, but gold and silver themselves remain resilient. Vermeulen believes this emotional selling could carve out a lasting bottom in the precious metals sector. With seasonality patterns suggesting weakness into mid-November before a rebound, the stage may be set for gold and silver to benefit most as we move toward year-end. Let's get into the interview.
Yes, I'm bearish. I think a lot of bad things could happen, but I always explain we're long the markets here, even though I do think, that things are coming. So there's a huge difference. I mean, this is also part of the problem of, I share analysis and things publicly, but the investing and the actual trades and stuff is for investors who I work with. So I share the analysis and where, are we long, are we short, what do we own in the overall trends, but I can't give the exact details of every position we're in. So I think people kind of have to piece that together at some point, right? So it's I'm always looking for problems and making sure you're mentally prepared that something bad could happen. And more important or equally important is you need to have an exit strategy for when it rolls over. And so we get in and we get out of the market because you never know when one of the corrections are going to turn into a big sell-off. I mean, if you go back and you look at the big sell-off earlier this year in the stock market, this is the QQQ. Our strategy told us to get out, then we go into this massive sell-off. And then eventually, we got to avoid all this and we got to buy back into the markets at a lower price and then ride it higher. And, one of the comments was something like, this guy doesn't know jack shit. And he says, he said not to buy after Liberation Day. Well, the reality is we did buy after Liberation Day, but we waited until it went from a bounce to a trend. And so I don't just buy after a huge sell-off because that big sell-off might not be the bottom. It might continue to sell off. And of course, if it did, then whoever bought trying to pick a bottom is going to get absolutely slaughtered and they're going to be underwater for years. So, it comes down to just understanding the strategy that I have. I'm all about protecting capital. I'm not swinging for the fences trying to make money on every single bounce and drop. I'm trying to identify these waves. When a swell or a wave comes to an end, I want to get out. I have green as the panic selling indicator because when we're in an uptrend, you want to buy dips or you want to know where there's a pivot low. So when the market sells off and our panic indicator, our green one, spikes up, usually it's that day or the day after. So it depends on the level, right? So for example, when it breaks above 3, typically this day or tomorrow can be bought. Usually the market will have a bounce for 1 to 3 days afterwards. If the panic indicator actually closes at 7 or higher, that is a level where if you go back on the charts a long time, it will usually be a standout low, meaning usually there's so much fear on the close of that day, the fear actually carries over for 1 or 2 more days. So the market can keep falling for 1 or 2 more days because everybody's just running to sell. And it usually takes 2 to 3 days for the world to kind of catch up, right? There's the day traders and the active traders like us who can take action the day something happens. And then you've kind of got a bit more of the working class who come home after work and they see it on the news and like, oh crap. And then they put their order in, they get out the next day. And then there's also people who are a little more lagged and they're like, oh, it's another bad day. Finally, they're going to get out. So depending if it's a very high level of panic, 7 or higher on the scale, then it's usually 2 days later or so, it's a very big buying opportunity in terms of the market being a big standout low on the charts.
In this discussion, Chris Vermeulen sheds light on how emotions often cloud decision-making in volatile markets. While he remains cautious about potential market downturns, he emphasizes the importance of having a solid strategy, one that prioritizes protection over prediction. Rather than chasing every bounce or trying to call the bottom, he focuses on identifying major trend reversals and safeguarding capital when markets show signs of exhaustion. He points out that understanding market psychology is key. Panic selling, marked by sudden spikes in fear indicators, often signals that a market low is near. Vermeulen explains that when fear levels reach extreme highs, typically above his key threshold, that's when markets tend to form a strong bottom. Yet, he cautions that such turning points don't happen instantly. Fear lingers for days as slower investors react to the headlines and exit positions. By following structured indicators rather than emotion, he believes traders can turn fear into opportunity. His approach is simple. Be mentally prepared for downturns, know when to step aside, and let data, not emotion, guide your moves. If you found this helpful, like, share, and subscribe to the Metal Bar. Turn on the bell so you don't miss any updates. And comment below to share your thoughts on gold, silver, and the markets.